Hello and welcome to the Small Business Briefing and happy holidays, everybody. It's hard for me to believe that the year's gone by so quickly. When I was younger, people always used to say, the older you get, the faster it goes. Turns out it's true. 46 years later, it's I would say the fastest year of my life, but really thankful to have spent all this time with you over the course of this last year. My name is Brian Kelly, the CEO of the Small Business Association of Michigan.
Hi, everyone. I'm Sarah Miller, Vice President of Marketing and Strategic Communications. And yes, Brian, I echo that sentiment. I feel like the year has truly flown by, and we really are thankful for all of you tuning in here twice a week. So I do want to say thank you to our sponsor, Consumers Credit Union. I hope you'll visit them at consumerscu.org. We do have a special guest joining us today. We have Chelsea Moore, who's the product manager with Blue Cross Blue Shield of Michigan. She's actually back on the show to talk about Blue Cross's expansion of Teladoc Health Solutions. So Chelsea, welcome back. And please tell us more about what our members can expect with this new solution come January 1st.
Yeah, thanks so much for having me back, you guys. So we're really excited about this expansion. There's a lot of stuff happening in the digital health or virtual telehealth space, if you will. But the expansion I wanted to talk about today is what we're doing in the condition management space specifically. So up until this point, our fully insured members have had access to the diabetes management solution through a vendor called Livongo. We've had that in place for over a year now, and we've seen some amazing engagement and utilization, some even better results when it comes to A1C reduction and just people sort of overall managing their diabetes specifically much better. On January 1st, however, we're expanding those offerings past the diabetes space and also into the hypertension management space, the diabetes prevention space, as well as just the weight management space, and kind of recognition that there's a lot of other conditions that members could have. Diabetes is obviously a really big focus of ours, but based on, like I said, kind of the engagement and success that we saw so far, we wanted to sort of broaden the condition management horizons to cover a lot more conditions that people will be struggling with.
It's a great tool, and obviously just the way that the world is going and people's comfort in these types of accessing services in this way keeps on increasing. So it's a smart benefit, obviously, for consumers. Maybe a little bit about what this means for employer groups. Like, what value does this bring to the employer groups that are covered specifically under the SBAN plans?
Yeah, for employer groups, I think this really does enrich the benefits that they have to offer to their employees even more, especially in this condition management space. We hear from a lot of members that these are things that they deal with every single day in their life, 24/7, 365. And even if they are an A+ Gold Star member, they are going to see their PCP once a year. Maybe they're even seeing their endocrinologist a couple of times a year. It's just not enough for them, for them to manage these conditions every single day. They need more support than that. And so that is where offering these more digital health tools helps them. They can connect with somebody at any point in time. They can ask those questions. They can, talk about their day-to-day life and get education on small, sustainable lifestyle changes that they can make to help manage their condition better. So it's a much more wraparound service for those members specifically. And when they feel cared for like that, and when they feel that their employer groups care enough to care for them like that, I think that is where we see a lot of the value to the actual employer groups from their members.
Yeah, you could really see how it would improve access, of course, is what we've been talking about, but also just kind of disruption in the work life. Like the idea you take time out and you drive someplace and you meet with somebody, and you can see how that it would be used much more sparingly if it was that big of a disruption. Yet this is the sort of thing you'd see somebody pulling off on a break or at lunchtime, or there's no disruption really at all to just the flow of regular life by putting this tool on the table.
Yeah, I mean, you pull out your phone to check Facebook or Instagram. You could also check your blood glucose level or a message from your coach today that's really encouraging you to continue to make good food choices throughout the day, or keep you motivated on your 10,000 steps a day journey. It's really something that people are getting more and more used to, having that kind of access to them available in the palm of their hand.
So Chelsea, we know these solutions have been in the self-funded space for about 18 months. So what kind of outcomes did you see there?
Yeah, so we've seen some great outcomes, and especially with the um, holisticness of these solutions. What the fully insured members have access today is simply just diabetes management, and what they'll have access to tomorrow is helping with their diabetes, but also helping with other comorbid conditions that they could have. It's really rare that we see someone with diabetes that also doesn't have hypertension and high cholesterol, and just helping with the diabetes isn't necessarily going to help with their overall health if they've got some of these other conditions. So in the self-funded space where we've had this available to members, we are seeing the majority of the members enroll to get help for 3 or 4 plus conditions that they have. So we're already seeing the value that they see in this, which is just like, it's not just my diabetes, it's all these other things too. And I'm clicking this box and joining this program and getting coaching here, and we're seeing that whole person health increase more than just, hey, you help me with my diabetes. But from a diabetes perspective, we're seeing over a 1% average A1C reduction. We're seeing over a 10 mmHg reduction for that systolic blood pressure. Our members in the diabetes prevention solution are losing on average 5% of their weight loss. So all of those clinical outcomes together, not only help make healthier members, but also provide the groups with a lot of cost avoidance. You have healthier people, they're not having heart conditions, they're not needing all of this additional care, and we hope that they'll see the value from a cost avoidance perspective too.
Yes, absolutely. And what a fitting time of year to roll this out on January 1st, when many of us will be looking to make some new healthier choices in the new year. So we'll be sure to share additional details with our members as they become available. And Chelsea, thank you so much for joining us here today.
Yeah, thank you guys again for having me. And I'm always happy to come back if there's interest to learn more. So just let me know.
Absolutely.
All right. Well, have a happy holiday, everybody. And I hope to talk to you guys again soon.
Yes. Happy holidays to you too.
Bye.
All right. Brian, let's talk about population numbers. We've certainly had this discussion on the briefing before, but now we have some data in 2023. Numbers are coming into focus. So what does Michigan look like? What did we look like this year?
Yeah, this is, we talked about the Growing Mission Together Council, and it's like the Population Commission. The governor put together some recommendations last week that were released. The Census Bureau put out their 2023 estimates. And so we all know that every 10 years, there's the big census that our federal government does. But the Census Bureau also does year by year population estimates um, that are based on surveys per state. And Michigan actually did not net lose population this last year, so it more leveled off. It's actually up about 4,000. So generally level. Remember, we had 10 million people, so a 4,000 person increase is pretty flat, but at least didn't drop. This is the first time that it didn't go down since 2018. So 2018 was a modest population increase. 2019, 20, 21, 22. Those years we went down each year. So this would maybe perhaps signal a a bottoming out, if you will, in terms of like actual declines, which is different than proportionately smaller compared to other states, which we'll talk about in a little while. But in this case, if you really peel back what's behind this, so we shrunk for 4 years. Now we're basically level, up just slightly, but still down about 40,000, down about 40,000 in our population since 2018. So there are different categories. You have births, deaths, you have migration, people moving in and out from other states, and then you have international immigration. So there are two things that made us go from losing to stable or a tiny increase. Those two different factors are the rate of death in our state looks more normal. For a few years, especially during the COVID years, there were just more deaths than normal on an average year. That has kind of normalized. It looks more like the pre-pandemic times. So that's part of this formula that resulted in the population change. We're still losers on net migration to other states. So more people moved elsewhere than moved here. So we have lost there, but we also saw kind of a normalization in international immigration. So for a while, international immigration kind of just stopped. And Michigan has always had growth year over year. It had some inbound migration, and so that has kind of returned to what looks pretty normal compared to what it was prior to 2020. So those factors have really kind of worked together, but it doesn't change the fact that our state is still proportionately. A lot of states have grown quite a bit, but Michigan, at least, the first step to growing is to stop shrinking. And it does look like, at least the estimates from the Census Bureau is that at the moment anyway, we are not shrinking.
All right, so you did mention other states. Who are the gainers and the losers around the country?
Well, the biggest population losers were California and New York, and then this is shaping out. This decade, I think, is shaping out, giving trends, and it doesn't look like it's going to change anytime soon. The Southeast are the gainers. I mean, Texas also, like, so south, but Florida and Tennessee and Georgia, those population trends that they're increasing quite a bit. And in fact, if you were to if you kind of boil this back into a political calculation, like the population determines how many congressional seats each state has, and so states after the next census, just the way the trends are going right now, those states in the South and Southeast really they stand to gain a lot of congressional influence as the majority of the growth happens there. So even though some states aren't growing, like Michigan, we're not shrinking anymore, but we're not really growing either. Other places that are growing will have more of a proportion of the U.S. population, therefore higher political representation as well.
All right, so based on the numbers, what do you think Michigan's trend arc looks like moving forward?
Well, unfortunately, it's not particularly good. Our demographics, in terms of just the age of our population, projections on how many kids people have, births versus deaths. I do expect that immigration will continue to be, in terms of population, a bright space. And please people should not confuse that with border security issues and on the Mexican border. That's not what I'm talking about here. I'm talking about just regular immigration. It can happen through our university system. It happens. There are some refugee programs that connect people here in Michigan as well. But I'm talking about, like, there are a lot of different immigration pathways that are not people sneaking over the border. And those are the things that have contributed to Michigan's growth, and probably will continue on into the future. But I think it's going to be a real struggle. If you were to look back in the 1960s, I think it was after the 60 census that Michigan had 19 members of Congress. So our congressional delegation was 19 strong. Today it's 13. Every single census, even if we didn't shrink, our proportionate growth was smaller than other places, and it shifted that. Now our congressional delegation stands at 13. So that's some projections are showing that Michigan would shrink from 13 to 12 in the next census members of Congress because of the fact that the growth is happening elsewhere. And when you divide 435 the country into 435 pieces, which is how many members of Congress there are, the places that have more growth are the ones that will have more of that representation. So I think it's going to be pretty tough. Something is going to have to change in Michigan to change that trajectory, because what's naturally in place right now, even though this year feels like a little bit of a reprieve, we will continue to fall further behind.
All right, kind of have a new topic to move to, and that is car insurance. People may have noticed that there has been some increases in your car insurance premiums. And Brian, can you share the reason behind that?
Yeah, there's something called the Michigan Catastrophic Claims Association assessment. So Michigan's car insurance comes with health coverage or health care coverage, including long-term residential type care for people that have traumatic brain injuries and serious car accidents that leave them debilitated. And that has been the source of a lot of controversy over the years. The governor signed in 2019, Governor Whitmer on Mackinac Island, with the support of legislative leaders at the time, a change to that system. And that it made big changes in terms of, this mandatory lifetime coverage that everybody had to buy before is no longer mandatory. But then there were also some issues being fought out over what coverage people who were already in the system before 2019 were entitled to. It was in the courts. So there's this big thing moving through the courts. So the law changed, then there was a lawsuit. Then there was a decision made. You might recall the governor announced that $400 refunds would be sent from this catastrophic claims fund to for every car and every owner of every vehicle in Michigan, because that law changed and it's had a lot of savings in it, and we're going to send all the money back. But the Catastrophic Claims Association lost the lawsuit on the treatment of the people that were already in the system. And so all of a sudden, a lot of these expenses that they thought they didn't have to pay, they do have to pay. So the Catastrophic Claims Fund that is assessed on all of our car insurance, that went from having a surplus that got sent out to people to flipping and having a deficit. And so now they have, there are these liabilities that the claims fund has to pay. And so the way it stands today is there's an assessment of $48 per vehicle for deficit. It'll show up as deficit recoupment. And then if you have chosen the unlimited lifetime coverage, that the assessment on that will be increased by $36. And most drivers actually do pick that. So my experience is that most agents recommend it as well. So that is that's really kind of flipped around this thing where it was like a decrease and a refund is now is turned into additional assessments to recoup some of what was sent out before that court case. So anybody out there, whether it's a commercial vehicle or personal vehicle, if you look closely at what you get billed for in your coverage, you'll see that the medical part of the coverage has a pretty substantial percentage increase.
All right, well, thanks for the update there and the clarification on what we can expect moving forward. So Brian, it is our last show of 2023, and you missed Monday's show, our traditional Data Monday report. So I think you've put together some slides for us today.
Yeah, so what I want to do here is share just some, I'll think of it like a year-end wrap-up where things kind of stand. And actually, you know what, I'm looking now and I think I've shared the wrong thing. So let me just pull up. That was one of my slides, but that was the whole presentation. All right, here we go. So what I want to share with you is our results for some of the major indices that I've been looking at over the course of our of this year. Number one is inflation. So that's where we're starting. A lot of news a couple weeks ago about the November inflation numbers and the decision by the Federal Reserve to not increase interest rates, but in fact, not only are they not increasing interest rates, but also projecting next year 2 or 3 interest rate cuts. And that is directly tied to how they're feeling about the inflation numbers that came out. So what you'll see on this graph in blue is the CPI, the regular consumer price index. This is that headline inflation, the one that hits the news, 3.1. Not as low as where policymakers want it. They like to see it around 2, but as you can see from this graph, it's got a pretty steep downward trajectory. So not decrease, it does not mean decreases in prices. It means prices are increasing slower. They would like to get it so that prices are increasing annually about 2%. That's considered healthy, or the target. 3.1 is still, though, if you look backward on this graph all the way back into the 90s, you'll see that 3% is not too far off normal. And but if you look at core inflation, still a little bit higher. That's the orange line there at 4%. So that takes commodity food prices and gasoline, energy out of the mix. Those move very quickly and on different factors. So in fact, I wanted to pull out the gasoline prices. So you see the gasoline prices, they had topped out. I think it was the year before last, but it had come down, but actually come down pretty steeply here just recently. And that has driven a lot of that increase. So the difference between the core inflation and the overall inflation, the reason the overall inflation looks a lot better, mainly because of gasoline prices. And but those jump around. You don't want to base your monetary policy on shorter term gasoline prices. If you look at those same two things, overall inflation and core inflation, it shows up on the month to month numbers. So a 0.1 increase in overall inflation month over month, and 0.3% in core inflation month over month. So even in core inflation, though, this bottom set of bar graphs, there's every month how much did prices go up, and you can see that it is generally a downward. It's a slow downward trend, but it's definitely a downward trend, and so I think that's the reason why you're finally feeling confident, or more confident, that they can ease up on these monetary policies. Now, I also wanted to share wage growth, but I decided to select this slide because it shows wage growth with the consumer's price index. So this actually was put together right before the new inflation numbers. So you see it's the October, but it was almost the same. October is 3.2, November consumer price index 3.1. But you'll see the big thing here is that wage growth was 4%. The average hourly earnings, and the overall wage growth was about the same. But wage growth higher than inflation. It wasn't, just a few months ago, inflation was higher than wage growth. So while I don't think this is it hasn't been, this condition that I'm showing you right now has not been present long enough for people to feel relief. It is something that is a pretty positive sign. So yet another thing, you want wage growth to be higher than inflation. You want and to have wage growth not driven by inflation, and then inflation to be lower, but ideally it would be a little bit lower still than it is today. Looking at the unemployment rate, 3.7%. So pretty historically, at least in during this particular decade, with the exception of the pandemic spike, looks pretty average, pretty solid where it's at. Again, if you were to look at the confidence that the Federal Reserve has that you can, inflation is coming under control without causing any big damage to the economy, you can feel in their comments and their projections that they're more confident. This is really one of the reasons why, and this is the other, and that is the monthly jobs report that also came out since we last did a data report. And up in November, a couple 100,000 jobs, and that's considered, remember, in 350 million people in America. So up 199,000 is, is just, it's kind of like, not great, not bad, and that's really what they're looking for, believe it or not. What the monetary policy makers are looking for is for this not to be that hot, but also not to be bad. They're just looking for it to be just very moderate. And so that would mean that the chances of recession are tempered a bit. And while the inflation is clearly going in starting to go in the right direction. If you're to break it into segments, though, where they're coming from, education and health was the biggest portion of that, and then government behind that, leisure and hospitality making a comeback too, and you see manufacturing up. I think that had a lot to do with just post strike normalization, and then consumers. How are consumers feeling? Household financial situation, asking, are you better off or worse off than a year ago? This graph just shows the ones that said much better off or much worse off. And this is still showing where people are not particularly feeling it. So I showed you a lot of stats that look actually pretty good, like things are starting to turn in the right direction. But remember that for any household income, you got borrowing costs are higher, real estate costs are really high, prices rose for a couple of years faster than their wages did. And even though some of those things look like they're starting to turn around now, people wouldn't necessarily be feeling that yet, that this is something that's kind of new trends. And clearly these numbers show that far more people feel that they are not just worse off, but much worse off as to a year ago. About over 10%, 12% or so, 11%, I guess it says, of people, those saying they're much better off, only about 3%. So that's the data report that we have to close out the year. And I would say that, if I were to go back in time and tell myself in January that was the data report for the end of 2023, I think I'd have been quite happy with that. It's been a slog to get the inflation back to something that feels pretty normal, and to get a place where wages have kind of started to stabilize, and where unemployment didn't spike, the economy didn't contract. Still some risks for next year. It's not like recessionary risks have gone to zero, but all of these factors look like 2024 is actually going to be perhaps that soft landing that the monetary policymakers were hoping for before. So, knock on wood, this is closing the year here, comparing that to what the expectations were in January, it's pretty good.
Well, thank you for sharing those with everybody, and for continuing to keep everyone up to date on these important data points and trends. And thank you all for tuning in to the briefing today and this year. Happy holidays from all of us at SBAM. We will be back on January 8th. So we'll see you in a couple of weeks.
Thanks, everybody. See you next year. I hope you have a great one.